I think we're on the verge of the biggest bull market in commodities since the 1970s. Of course, this flies in the face with Powell claiming that inflation is going to go back down to 2%. There's no chance that inflation is going to go back down to 2%. All the data shows that inflation is on the way up. So everything's going to be cut through inflation. And the markets haven't even really come to this conclusion yet, but they may be just starting the process. So that is a big adjustment. And gold and silver have a long way to go, and they could start this with a very big move. The Dow could go up, the S&P could go up. I just think that the Dow is going to go up less than gold.
Gold prices reached a new all-time high on Thursday, marking the fifth occurrence this month. Despite a slight dip on Friday following a near-record peak the day before, gold remains on track for a weekly increase, buoyed by a strengthening dollar. The surge in gold prices follows the U.S. Federal Reserve's announcement of anticipation of 3 rate cuts in 2024. Chief Market Strategist Peter Schiff advises against waiting for pullbacks to invest in gold and silver, suggesting that any downturns would likely be brief and shallow. He emphasizes the importance of acting swiftly to secure assets as prices climb. Inflation has maintained around 3% since June 2023, surpassing the Fed's target rate of 2%. This indicates that the Fed will likely keep rates steady for the foreseeable future, having paused the federal funds rate at a target range of 5.25% to 5.5% since the second half of 2023. Peter Schiff argues that the Federal Reserve's decision to cut interest rates reflects broader economic challenges, such as financial instability, potential government default, and the need to stimulate the economy. He contends that the Fed's actions are driven more by the necessity to avoid crises than by an attempt to control inflation. Equity markets in New York and Asia surged as the U.S. central bank signaled plans to ease monetary policy despite rising inflation. Meanwhile, the dollar retreated, and gold hit $2,220 per ounce, extending its rally by 12% since mid-February. While gold in the stock market may witness gains, Peter Schiff suggests that gold will likely outperform stocks in the long run. Join us as we delve into insights shared by Peter Schiff. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Price of gold, and it is now at a new high. It's up $17 an ounce this evening. We're at $2,204. And I expect an even bigger move in the gold mining stocks. They could just explode higher tomorrow. They were up about 4 or 5% today, if you look at the GDX and the GDXJ. But look, I wouldn't be surprised to see these stocks up 10, 20% in one day and then keep going up. You know, I mentioned on a podcast last week that the guys at Schiff Gold are telling me that there are a number of people that are waiting for pullbacks to buy gold and silver. And I'm telling you guys, do not wait for a pullback. It's not worth it. The pullbacks will be quick and shallow. And so there's not a lot of reason to wait. Just buy, because the sooner you buy, the cheaper it's going to be. Because I think we're now just starting this turning process. The Fed is not hiking rates. The Fed is cutting rates come hell or high water. It doesn't matter what the data is, right? The Fed is going to cut rates because the country is broke. They're not cutting rates because they won the war against inflation. They lost that war. They're cutting rates because they have to avoid a financial crisis, a banking crisis. They want to try to reelect Joe Biden. They want to try to save the government from having to default and cut Social Security and cut Medicare. And so everything's going to be cut through inflation. And the markets haven't even really come to this conclusion yet, but they may be just starting the process. So that is a big adjustment. And gold and silver have a long way to go, and they could start this with a very big move. Now, that doesn't mean that the stock market won't go up either, right? The Dow could go up. The S&P could go up. I just think that the Dow is going to go up less than gold. And so what does that mean? If both the Dow and gold go up, but gold goes up more than the Dow, then the Dow is losing value in real terms. And in fact, if you go back to the beginning of the millennium, if you go back to the year 2000, gold is up more than the Dow, even though the Dow is almost 40,000. The gold price has gone up more than the Dow. But now the gold price is about to really accelerate and leave the Dow in the dust. And that just means that the real value of stocks is going to be falling. But I think there are going to be stocks around the world, emerging market stocks, I think are going to really take off. I mean, there's going to be a big flight of capital out of the US dollar because this is all inflation. You know, when Jeremy Siegel was talking about this strong economy, what Jeremy Siegel doesn't understand is it's inflation. He's confusing inflation with economic strength because inflation can create an illusion that you have a growing economy. That's one of the reasons that government creates it. And that's especially true if your indexes underreport inflation, especially the GDP deflator.
Federal Reserve Chair Jerome Powell reiterated his commitment to ensuring inflation moves closer to the central bank's 2% target despite recent spikes in inflation readings. Powell emphasized the importance of confirming last year's low inflation levels and gaining confidence that inflation is sustainably reaching the target. However, Peter criticized Powell's dismissal of the recent inflation data for January and February. He argued that attributing inflation to seasonal effects, especially when the data is already seasonally adjusted, is not a valid explanation. Additionally, Peter disputed Powell's characterization of inflation as transitory, pointing to underlying economic conditions. In another development, Powell hinted at the Fed's intention to slow down the pace of its balance sheet reduction, a move expected to be announced at the next meeting on April 30th to May 1st. According to analysts, this decision could allow the Fed to shed more bonds than previously anticipated. Peter further predicted that the Fed may eventually use quantitative easing to address ongoing economic challenges and combat inflation. Let's get back to the interview.
I think we're on the verge of the biggest bull market in commodities since the 1970s. Of course, this flies in the face with Powell claiming that inflation is going to go back down to 2%. There's no chance that inflation is going to go back down to 2%. All the data shows that inflation is on the way up. Plus, if you understand what inflation is, it's got nowhere to go but up. And that, I think, is why the markets reacted the way they did, because Powell basically dismissed the bad inflation news that came out for January and February. I mean, he kind of said, well, it's due to seasonal effects. Well, it's already adjusted for that. So it's like you can't say it's seasonal when the numbers are already seasonally adjusted. It's like saying it's transitory, which basically is what he said. So he dismissed it, and the Fed is still saying that we're going to get 3 rate cuts this year. But in addition to that, even more dovish than that was the admission by Powell that they're going to begin shortly in reducing the size of their asset sales, quantitative tightening. They're going to pare it back. So they're going to start shrinking the balance sheet more slowly. Now, I've been saying the Fed is going to go back to quantitative easing. This is just the first step in that process. First thing they do is less QT, and then the next thing, they're back to QE. Because if the Fed really was serious about fighting inflation, the balance sheet is still much too big. It needs to continue to shrink, and interest rates are not high enough. They got to go up. Let me look at a couple of the inflation reports that we got after I did my last podcast on Wednesday, because I talked about the hotter than expected CPI. But what I didn't talk about was the hotter than expected PPI, which was even worse, that came out the following day. February producer prices were supposed to go up by 0.3. They went up by 0.6, double what had been the estimate. And in fact, the range of expectations went from 0.2 to 0.3. So double the high end of estimates. Now, year over year, and producer prices had come down a lot, mainly because commodity prices had come down a lot. Well, they're not going down anymore. They're about to explode. But anyway, so the expectation was for the year over year increase in producer prices to be 1.2. Instead, it was 1.6, up from 0.9 in the prior month. Now, again, the range of expectations for the year over year PPI was up 1.1 to up 1.2. So a pretty narrow range, but we came out well above the top end. And even if you take out food and energy, the core was supposed to be up 0.2 and it was up 0.3. But this was a bad report.
The Fed maintained its outlook for 3 rate cuts this year, signaling confidence despite recent inflation upticks. This spurred investor optimism, leading to strong inflows into gold-backed ETFs like the Spider Gold Shares ETF, which rose for the 4th consecutive day. At the same time, factors like geopolitical risks and central bank buying have driven this year's gold rally, and increased demand from ETFs hints at a potentially sustainable uptrend. That's all from us. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.